Hello and welcome to the Gift and Home channel. I'm Tom Ungrodt, and the first segment we're going to go through today are the basic financials. I want to refer to these and try and walk you through what I think is important to have as a store owner or potential store owner. The first would be a balance sheet on an income statement. Highly recommend you, of course, go out and find the appropriate professionals to work with, but I'm going to walk you through what is an example of what I think is a good basic way to start. So the balance sheet is one way to go. What I've got here in front of me, and you will see, are the assets, basically, and liabilities. What we're referring to, your biggest asset naturally, is your inventory. Inventory we will get into in a little bit, but in our definition here on the balance sheet, it is by far your largest number, and it's something you want to refer to. I have an 05-06 comparison in front of me. Our inventory in 05 was $215,000, and in 06 was $260,000. We increased our inventory knowing that we needed more inventory to operate and grow our business. Other things that you should be aware of course, under the current assets are your cash on hand, petty cash, and registered cash. Any cash you have on the property has to be recorded on a monthly basis and updated. We didn't have any prepaid expenses. Generally, you will not. Your inventory is your other current asset, as I mentioned. Your fixed assets, things like your leasehold improvements, your accumulated depreciation on your leasehold. You buy them, you must depreciate them over time. These all have to be recorded. You must continue to invest in your business with your fixturing along with your inventory, and it's shown as part of your fixed assets on your balance sheet. Fixtures, accumulated depreciation again on your fixtures. I should backtrack for quickly and mention leaseholds would be your lighting, things that you build in that will not be removed. Your fixtures are things that you can actually remove if you were to change different locations. Your sign. Everybody has to have a good sign outside, and you depreciate that, and in our example it was $1,500 and it's fully depreciated. Other assets, there's goodwill. We've been in this location, for example, for 30 years. And we have naturally built a great reputation and goodwill. And when you buy a business, that's part of a formula. And we have that listed as $25,000 on this statement. Total assets, for our example, are $410,000 versus $401,000. And then we get into our liabilities. Well, naturally, you have to pay for your inventory. So your first liability are your payables in the trade. And we'll talk a little more about that later on, but it's listed here as $123,000 at this point in time. We pay a lot of our bills right after the Christmas holiday season, and again, my example is December 31. Other current liabilities, you have sales tax. You must pay the state on a daily basis for your, or on a monthly basis for your sales tax. So our total current liabilities in our example are $134,000. Long-term liabilities, notes payable. You build a business, you remodel, you move to a new location. We did. It was $350,000. Then you get down to your equity area. Your equity area, beginning retained earnings. What do you really end up with at the end of the year? What do you really have in the business after your current assets and current liabilities? And we had $151,000. We showed a loss going into the fourth quarter, and that loss will be reflected in your net income. And then you have total liabilities and equity of $452,000, which is going to be equal to or hopefully less than your total assets. So as a balance sheet, it's a very basic, but you should refer to this, and it will be produced every month throughout the year. The next is a profit and loss statement. Also very, very important in your business. You really need to know where you stand every month. That gives you an overall picture of what you own and where you're going with assets and liabilities. But this really tells you is a good, one of your best operating tools. It lists your income or your sales for the period, again using December 05 and 06. And we have a total income of $237,000 or sales in the month of December versus $214,000. So we had some growth of $23,000. You have total income of $195,000 You have your merchandise or your cost of goods of $100,000. That's what you brought in during the month. You have freight, which is at the top of your statement under cost of goods. Freight is a factor, particularly lately in our operation. It still runs less than 2%. And then you get into your expenses. And without expanding on those at this moment, we will get into that in our future segments. Our expenses in this store for this example was $38,000 for the month. And so we have an ordinary income of $52,000. Other expenses, purchase discounts if you pay on time. Usually in our industry, you'll receive discounts, and it's encouraged that you certainly do that. So the net income for the month was $53,000 versus $42,000 last year. We had some nice growth for the month of December. The last statement, which is one that we all have a tendency to ignore, but it's a cash flow statement. It's the most difficult in the world to build, but you need to have it. In the gift business, the first 9 or 10 months out of the year, we have a very, very difficult time with cash. We generally are spending more than we bring in. You hope that entering the fourth quarter, if you're lucky, you'll have a positive cash flow. And after it's all over with at the end of the year, of course you will. But basically, this summarizes your net income. It talks about the net cash provided for operations for your inventory, your payables, trades. And it's a summary or a combined statement of these last two. And your investment activities, leasehold improvements, accumulated fixtures, your notes that you have payable, you're paying the bank for improvements in your business. And it asks you or tells you if your cash flow is increased or decreased. Now in our situation, because our inventory increased, our cash flow decreased. And cash at the beginning of the period was $69,000. Cash at the end of the period was $43,000. And you should match up for that. So it's critical that you really develop a cash flow statement in this business. It will show a lot of negatives. This statement does show negatives at the beginning. But hopefully, if you run your business right, you will slowly accumulate cash and have the old rainy day fund, as they call it, at the end of the year, so you can go into market in January and start to rebuild your inventory. To provide you with all of this, today the environment has changed. Again, I recommend a qualified CPA, and I'll talk about that earlier, or accounting firm. But there are good, excellent software programs for small business out there. Just to name a few, QuickBooks, which is something we use in our company. It works very, very well, and my chief financial officer considers that to be #1 in our arena. Peachtree, MS Dynamic is another, and MS Office, either Excel or Word, using some of those are all possibilities for a small business today. So in the long run, it's very, very important that these three parts of your financial picture be produced on a monthly basis. You can produce them, you can have an accountant produce them, but it's highly recommended you sit down with your accountant and you go through them if you choose to do it yourself. Thanks for listening, and our next session will be a retail revenue breakdown.